Well, sorry about yesterday. I didn't get to upload anything. I was out of the house for like 12 hours and just didn't have a chance to record and upload anything. But I'm still stewing over this reverse repo issue. And I've been struggling with this for a long time, and it's like pulling teeth. It starts to make a little more sense to me bit by bit. And every time I figure out a little bit something more about the reverse repo issue, it feels like an epiphany in my head. And so last week, it was a big week because reverse repos for the first time hit $500 billion. It had never gotten that high before. And after Fed Day, which was Wednesday, the next day, reverse repos shot up to $750 billion. It went up by 50% when it just made an all-time high at around 500 billion. It shot up to 750 billion. And after that, it really hit me. It bugged the hell out of me all weekend that I had no real concept as to why this was happening or what importance it held. And I don't fully get it yet. I'm still learning. I still have a lot more research to do, but I figured something out. Not on my own. It's big help today, although I was already sort of going in this direction. But the last thing that really helped bring a lot of this together for me was Zero Hedge's write-up of Zoltan Pozar's, and I think I always say his name wrong, but Zoltan Pozar is a guy who works for Credit Suisse, and I guess he used to work at the Fed, and he does a lot of writings about the repo market. And their write-up of what he's saying about Fed Day last week and what's going on with the repo market, the reverse repo market in particular, combined with things that I had already sort of had, swimming around in the back of my head, has brought me to the conclusion that the Fed is in fact already tapering their asset purchases, and they are tightening monetary policy. I think that is the effect of this last Fed meeting. I believe that the Fed has changed directions and has clearly moved affirmatively in the tightening direction. Now, I might be wrong about that, but I'll lay out my case. I think it seems pretty simple, but it's so simple to the point to where I think, well, gee, how would more people not see this? And that is that they raised the reserve repo rate, meaning the rate of interest, essentially, that banks can, or whoever else is qualified to participate in reverse repo, is paid by the Fed for essentially lending the Fed cash in exchange for T-bills or whatever assets the Fed wants to give them, in terms of for collateral in this reverse repo operation. Ordinarily, in the olden days, and by the olden days I mean the last couple of years when over the since the financial crisis in which reverse repo has existed, the Fed would offer zero interest. If you were engaging in reverse repo with the Fed, you were just parking money there for free because you had nowhere else to put the money. And the purpose of that was to prevent interest rates from going below zero. The idea is that the Fed has trillions and trillions in assets on its balance sheet, and that in terms of safe, quote unquote, safe U.S. government bonds, and that if they essentially offered people access to those bonds at a 0% interest rate, essentially, whenever interest rates got to the zero lower bound and potentially could fall below the zero lower bound, there was this pressure release valve known as the reserve repo facility in which they could go and park their cash in exchange for bonds for 0% interest. And that would put a floor at 0% in the market to make sure that the United States, unlike Europe, did not have negative yielding bonds. And so in effect, what the Fed does when they conduct reserve repo is they are pulling bank reserves out of the banking system and putting bonds, treasury bonds, or I guess mortgage-backed securities in theory too, back into the banking system and into the market. Every time that the Fed conducts any reverse repos, that is in a way quantitative tightening. they are, instead of sucking bonds out of the market and replacing those bonds with more bank reserves, which is what QE is. That's when the Fed goes, quantitative easing is just the Fed going out, printing money, and buying bonds off of the balance sheets of banks. And reverse repo is the opposite, essentially. The banks take these bank reserves that were printed by the Fed and handed to them, and they go to the Fed and they say, hey, we'll let you guys have some of our bank reserves if you let us have some bonds. And so I think the way you want to look at reverse repo is that as reverse repo goes up, that is representative of tightening monetary conditions. Now, of course, it's only tightening enough to ensure that interest rates remain at zero and don't get any lower than that. And theoretically, if interest rates were to start rising in the rest of the economy, that money would then rush out of reverse repo and back into other instruments and other assets. But nevertheless, when reserve repo is ongoing, that represents a tightening. Now, what did the Fed do last week after Fed Day? It was something that I don't even know if I mentioned it, but it was something that I was kind of avoiding because I wasn't quite sure how to broach the topic or how to address it. But the Fed raised the reserve repo rate from 0% to 0.05%. That's 5 basis points. Now, 5 basis points doesn't sound very interesting, I'm sure, to most people. It's almost nothing. But when you're talking about hundreds of billions of dollars, it's something. And something is better than nothing, especially when 5 basis points is a higher yield than a lot of short-term U.S. Treasuries, what we call T-bills, because if it's less than a year, it's not called a bond, it's called a bill. And this short-term U.S. debt is all out to, I believe, 6 months, is yielding less than 5 basis points. And this is something that I couldn't figure out. And it's something that, thankfully, this article, which I'll link to, Zoltan Pozsar discusses it at good length. And this is something that last week I could not understand. I was looking at it, and I was saying, this can't be right. The Fed is offering 5 basis points in reserve repo, but here I am looking at the T-bills, and the T-bills are all yielding below 5 basis points, and they weren't going up. And I was shocked. Like, how can this make sense? Why would anyone be buying these T-bills when they can just go in reverse repo and make more money? And Zoltan's answer was essentially that it takes time, that there will be a rotation, but that what I thought was the common sense answer is correct. People, if they can own or if they can just go into reserve repos and make 5 basis points, they're not going to accept 4.3 basis points, which is I think like what the 3-month is yielding right now. And that would explain why we saw the reserve repo market on the next day after Fed Day shoot up by 50%, go up to $750 billion, approaching. Now we don't have the data for today yet, and the reserve repos did go down slightly by like 11 billion, I think, or no, I think it might have only gone down by 9 billion from Thursday to Friday, but it was still right at $750 billion. It didn't go back down to 500. It didn't go below 500. And so that to me is at least, that seems to be as good a confirmation as any, that this 5 basis point reverse repo rate is incentivizing people to park more cash at the Fed. And if people are parking more cash at the Fed in reverse repos, what is that equivalent to essentially? It is quantitative tightening. The Fed is tightening monetary policy. And so the other thing that was very interesting about what Zoltan was writing is that he went and did the hard research into what he thinks this will translate into in terms of how much money we're talking about that could rotate into the reserve repos. And he estimated, I believe, that there are about $2 trillion in money market accounts that are holding T-bills yielding less than 5 basis points. And so that means that these money market funds have an incentive to rotate out of the T-bills they're holding and into reverse repos, and that could be up to $2 trillion. And so that is essentially, well, no, I mean that would be a couple trillion in quantitative tightening. Now we don't know that it would get to be that much. It could be that once these funds start rotating into reverse repos, that the T-bill rates spike up to 5 basis points and then are going to level off there, because you have to remember how does the reverse repo thing, what does it do in effect is it puts a floor in interest rates. And so whatever the reverse repo rate is, it's very hard for anything to trade lower than that, because if you're giving a loan to the Fed is guaranteed to pay you back. The Fed can print as much money as they want. So if the Fed is offering you 5 basis points, nobody's going to be able to beat that, because that nobody is going to be a less of a credit risk than the Fed, because the Fed can't go broke. They can print all their own money. And so everything then would have to yield more than 5 basis points. But again, this is a form of tightening. This is quantitative tightening. And so I'm going to call it that last Wednesday was the beginning of the next tightening cycle for the Fed. And other than this past tightening cycle, there has never been a tightening cycle in which the Fed has not pricked the bubble and ultimately created a pretty bad recession that is typically proportionate to the size of the bubble. Now, the bubble that should have been burst back in early 2019, late 2018, that the Fed was in the process of pricking before Powell completely reversed track, that everything bubble would have been the largest bubble, much larger than the 2008 bubble, and would have been a much worse crash. But I will give Powell credit. He did the impossible, what I thought would have been the impossible, in that he was such a coward. He was able to reversed himself so quickly at, I believe, 2.25% on the Fed funds rate when they were raising rates back then, and quit balance sheet runoff. Was no longer on autopilot, and then cut rates 3 times in 2019. He managed to stave off that recession, and so it's still impending. We're still in the same bubble now that we were back then. The bubble has just gotten significantly bigger, a lot bigger. And as the bubble gets bigger, it gets more and more fragile. So, nowadays, the Fed would not be able, if the Fed wanted to start hiking interest rates, they would not be able to get up to 2.25% before they realized that they had to start cutting again. That we couldn't handle that. I don't think that this economy could not handle 1%, a 1% Fed funds rate. It wouldn't work. And so I don't know where the line is to where the Fed tightens to, because again, this is barely tightening. It's hard. This is such little tightening that I actually had to do some sleuthing to realize that the Fed was tightening monetary policy, because of course on TV the Fed is saying the exact opposite, that they're not thinking about tightening yet, but they're thinking about it. And in their meetings they are talking about it, but they're not to the point where they're talking about tightening in any sense, to where they're talking about even tapering, which again is implicit tightening. When the Fed tapers, that means that they are not expanding as quickly as they once were. They're expanding at a slower rate, and so it's an implicit form of tightening. But as I've said before, the Fed has to continually expand to continue inflating the bubble, because it is the Fed who inflates the bubble. The Fed is not just maintaining it. You can't just maintain it. You have to keep continually pumping more and more air into the bubble, or else it deflates. And so if the Fed has begun tightening, no matter how minuscule that tightening might seem, they're going in the wrong direction, and that's going to have consequences. How severe those consequences will be are yet to be determined. Now, where Pozar gets a bit deeper than I personally was, because at first, reading this stuff, it was confirming stuff that I was kind of already thinking in my head. But I wanted to hear it from somebody who was smarter than me to make sure to sort of get some confirmation that I had my head screwed on straight. But there's some additional stuff in this article that where they really talk about where this can go wrong. and that's where I start to get lost again. And I will have to just continue to learn more and to try and, figure this out for myself. But the gist of it, from what I gather, is that as we see this rotation from T-bills into reverse repos, Pozar predicts that you're going to see a rotation from bank depositors into T-bills. And so the bank people who now have, deposits with banks, and these are big financial institutions he's talking about, not necessarily individual people, are going to rotate out of their savings account and move into T-bills. Now, I don't fully grasp why that is. I assume it's because if you have the money market funds rotating out of T-bills, well, they need to find a buyer. There has to be somebody to buy them at some price, potentially a price that's higher than right now. I would imagine that people are going to sell their T-bills until they hit 5 basis points, to where it at least is the same, or if not a little better, than the reverse repo rate. And so where's all that money going to come from to buy these T-bills that the money markets, this potentially $2 trillion in money market funds that are going to shift over to reverse repo? Well, the only people who are making less than the T-bills right now are people who, or institutions rather, that have their cash deposited with commercial banks. And so if we have heavy deposit outflows from certain banks, because, there is no, I believe right now, as a part of the Wu flu mitigation, the Fed decided to get rid of all reserve requirements for banks. So I believe that banks don't really have to hold any cash anymore. They can invest as much as they want. If that's the case, then certain banks might have some trouble reaching redemptions. And so they'll have to go into the regular repo market, not the reverse repo market, and borrow reserves so that they can pay their depositors the money that they owe them. And so in doing so, if we see increased usage of the repo market, well, then you might see a new spike in the regular repo rate, not the reverse repo rate. Because remember, the reverse repo rate is something purely to having to do with the Fed. Whereas the regular old repo market, it's the regular repo market is just banks dealing with other banks. But there's going to be less cash in the repo market because of all the cash that's, the reserves that are being sucked up by the Fed's reserve repos. And so that's going to be a problem for these undercapitalized banks if you start seeing major outflows. But again, the problem that I have with this, I can't endorse this necessarily, because this is a lot of if this, then this, if this, all in a row. There's a lot of dominoes that have to fall here for us to get to this point. So I'm not, I would not come to this conclusion independently that because Powell raised the reserve repo rate to 5 basis points, that there's another repocalypse around the corner, just like we had back in 2019. I still don't really understand the first repocalypse and why that happened, because I was not following the right people back then. But hopefully, if this happens again, I will be in a position to where there are some people who I think will know what's going on, who I can see explain it well. And then there's even crazier stuff about how, if the repo rate spikes, well, then everything blows up, which I do kind of understand that, because overnight lending is very important to the financial system. But hey, you're witnessing me, sort of go down this journey, along maybe with some of the, with maybe the rest of you, because this is not stuff that they teach you in college, put it that way. We are watching financial history being made. And the Fed is making all of this up as they go. So there's no textbook for this. There's no hard theory books that deal with specific examples like this. My favorite book on finance, money and banking, monetary theory, all of this, all these topics is Mises' Theory of Money and Credit, which was written in 1912, and all of the examples that he gives in that book are, based on the financial system as it was in 1912, dealing with, with the gold standard, and even back, since he was in Austria, he remembered the days of the silver standard. And even while the principles laid out in that book still apply today, it's difficult to translate that sort of stuff into the modern context. This modern stuff that we have, a lot of this in finance only really originated in wake of the 2008 crisis, like reverse repo. I don't think reverse repos ever existed before 2008. And so for a lot of this stuff, there's just not precedent to look back on to try and understand the way these markets are quote unquote markets are behaving. So I'm going to continue trying to dive deeper and deeper into this, because it's not going to quit bugging me until I feel like I've really got a good hold on the issue. So with that said, I will see you folks back here tomorrow. I will not miss one. Tomorrow's not a Sunday, so I have no excuses.